You're watching Dukascopy TV for a look at bonds and equities. I'm Darren McDermott and this is Emmanuel Ferry from PBS.
Hello.
Welcome today. So first of all, let's have a look at this graph. Now, what are we seeing across the asset classes?
Well, so far this year, the big picture is completely the opposite of last year. I mean, the broad equity market is showing mediocre returns. Roughly speaking, we are up so far this year 1%. And in the fixed income space, the performance is above 3% this year after negative return last year. So we have a kind of reversal regarding returns. And from a risk point of view, the picture is also different because we have poor returns in the equity space with much higher volatility or more frequent pullbacks. So the asset class is more risky. On the opposite, fixed income, we can see that there is a search for yield, a strong appetite for carry, and the fixed income is so far this year the favorite asset class.
Okay, and looking at the second graph. Now, are high yields getting too expensive due to pricier junk bonds?
Well, regarding high yield, it is true that over the last 5 years, it has been the most compelling asset class with a cumulative return close to 100%. It's more than 12% on an annualized basis. So it's an outstanding asset class, steady returns, low volatility, and very limited losses. Today, this is probably the most crowded asset class, the most expensive asset class. But given the fact that we are still in an ultra low interest rate environment with ample liquidity and low volatility, so we can say that this situation will continue to prevail as long as the Fed stays on hold. So probably the search for yield, the addiction to higher yield will persist.
And emerging market outflows have actually been very positive for Europe, but have both bonds and equities benefited at equal levels?
Yes, it's true that Europe has benefited from outflows from emerging markets. Regarding equities, there was a rotation from growth to value, and Europe is probably the best play for this valuation adjustment, for this for this value rotation. Regarding fixed income, the sovereign debt at the periphery in Europe is a substitute for emerging debt today. So yes, outflows, the switch from emerging markets to Europe has been a driving force for equities and also for bonds.
And Emmanuel, will we see the US dollar benefit from the relative rotation out of US bonds and equities as they actually abate?
Dollar is probably the pain trade for investors. The bias is bullish on dollar still, in 2013. But the tapering triggered outflows on US equities and US bonds. So today the dollar is still weak due to these outflows dynamics. So probably the catalyst in the short term, the catalyst for a stronger dollar should be we need a reversal regarding flows, because over the long term, definitely the picture is supportive for the dollar, because at a certain point the Fed will start hiking, but it's a long-term issue. In the very short term, the currency is much more driven by flows, and so far this year, flows have been negative for the dollar and supportive for the euro.
Emmanuel, thank you very much.
Pleasure.
And thank you for tuning in to Dukascopy TV. Now do stay tuned as we have plenty more interviews and updates heading your way. Goodbye for now.